Another way you can impact the overall effectiveness of your trading and profitability, which is what we're really looking at here, is building on this concept of indicators and primary and secondary indicators. And that's with selective trading timing is a great concept you can use with that. So think of it as selective trading timing we're going to learn about and then combining with these confirmations. So maybe you like the idea, I hope you do, of having a primary and a secondary. That's a real core concept of technical analysis. And maybe you might add a third or maybe a fourth and maybe a fifth. It's up to you as you develop your skills. But let's start with a primary and a secondary. And then you can add to the trade as indicators are met. So maybe you want a primary, a secondary, you're good with a third, but then you maybe add a little bit more with your fourth and fifth indicators come in. So if you want to approach it that way, that can be a great approach too and use more indicators. So how does it work? So let's say you take a certain amount that you've designated for a trade, for a particular individual trade of an individual security, you're going to commit a certain amount of money. Let's pretend and say is $500. Students from all over the world, over 200 countries, so please just submit in that idea of rupees or euros or pounds or whatever yen, whatever you use. But let's say, for example, I have 500 units or $500. So maybe what I do is I break that up. Instead of putting it all in, I break it up depending on when these different indicators are met. So let's say if indicator 1 and 2 are met, my primary, my secondary, my most confident things, I put in $200. And then if I see, or either right away or when, if it progresses, a third indicator is met, a third different indicator is met, well, then I'll put in another $100 and another 100 for number 4 and another 100 for number 5. And the idea is that that you're kind of, instead of putting it all in right away, you're kind of building in as indicators are met. And you can change these amounts. Let's say you really only want to use 3 indicators or 4 indicators. Well, you could use $300 for 1 and 2, and then $100 for 3 and 4, and that gets you to your $500. Again, the amounts you use is completely up to you, of course. Just the concept of breaking it up and putting a little bit more on your primary and secondary, and then your third and fourth, so you put a little bit less, and you kind of work your way into those. And now when you get an indication that things are changing, like the trend is ending, and you put in, you might not have been putting in all your fourth and fifth, maybe you never were met, maybe you've got only $300 in this case. Either way, whether you have only, your smallest amount to fully in, once you see that there's a change or the trend is ending, you exit all at once. So you don't exit like in kind of reverse order or anything like that, or slowly exit. Once you see a definite sell signal, you want to get out and you want to exit and book your profits. Otherwise, you'll just as you built up your profits going up, you don't want to erode your profits going down. You want to build them up slowly and then protect them and then get out and do another trade. As far as doing it all over again is the idea. So that's the idea of how that selected trading timing works. Is I'm using these indicators, but I'm using the indicators as far as when certain milestones are met with this particular security that I'm trading. So it's a great way to kind of, add a little bit more safety without having to go all in on and trying to, feel like you have to really know that fifth indicator well. You could put a little less risk on, let's say, that last fourth or fifth indicator, as an example.